G'day guys, this is Jax Millar, the Wealth Mentor, and we are here for another episode of Financial Freedom Secrets. I've got my two business partners, Jim and Chad, here today. I've been trying for ages to get these guys on my podcast, and they've been coming up with a whole heap of excuses. I don't know if it's just me, or whether they're just very busy, or a combination of the two, but I'm glad that we can catch up. There's a lot of stuff that's going on in the world at the moment. We're getting a lot of questions around the state of the world, the state of the market, and how do people respond when it comes to their wealth and their financial freedom plans. So I wanted to get it straight from the source and share hopefully some valuable insights with you guys. So Jim, Chad, how you guys doing?
Great.
Morning. Yeah, pretty well. How about yourself?
Doing well, mate. Doing well. All right. So just for those who maybe haven't been introduced to you guys, let's start with you, Jim. Give us a 30-second snapshot of who you are and what you do, mate.
Yeah, so Jim Fairhall-Dicke. I've been an advisor now in the industry for nearly 20 years. I have always been very passionate about money and helping people achieve their goals. That comes from background of, not necessarily having a lot when we grew up with my mum. However, my mum had a really good financial advisor who was my first mentor, and that really springboarded me into the advice industry, and I've never left. And just grown and want to help clients continue to build wealth.
Love it, mate. Fantastic. And Chad, give us a 30-second rundown of who is Chad and what do you do, mate?
Well, yeah, so my financial advice journey probably started out when I was probably about 15 years old. So I love playing with shares. I like the idea of the thought process behind shares. You can have money, you can have a laptop, you can have an internet and, a bit of knowledge, and then hopefully you can try and make money. It doesn't work like that as what I had found out quite early on. But that's basically when my journey started. And I originally wanted to be a stockbroker or a financial analyst. And then just kind of, got into financial planning, and then worked at a couple of companies and worked at Westpac and worked at Macquarie. And then Jim and I started our business 5 years ago, roughly around about the same time you started yours, Jacko. And then we merged, and now here where we are.
Yeah, fantastic. And I think this is probably a good introduction to your clients as well. Like we merged, it's been like a 9-month journey now. We've basically created a business baby together, which is amazing. It's beautiful. But I think a lot of people probably say, who's this kind of lunatic bearded guy that cruises around? So for those who haven't been introduced, I'm Jax Millar. I'm also known as the Wealth Mentor. I've been in the wealth space for over 15 years now. It got started because my parents were business owners and they struggled with money. Worked very hard, didn't have much to show for it, and just really lacked the fundamental knowledge of how to manage their money and make their money work for them as opposed to them working for it. Started training as a financial advisor, but very quickly became disheartened because my experience early on in the industry wasn't a great one. It was a lot of people who are product pushing and selling commission-based products to people like my parents that really didn't solve the real problems that they were experiencing. So I started calling myself a wealth coach, and I created an educational-based philosophy to help people like my parents nail the foundations of their money and create a real plan to manufacture financial freedom faster. And over that last 15 years, I've helped my clients build over $2 billion in combined wealth. So that's me in a nutshell. So guys, let's talk a little bit about the mechanics of a wealth business. So starting with yourself, Jim, if you had to summarize what financial advice is, how would you describe it?
It's interesting, right? Like I've been doing this a long time and the fundamentals haven't changed. I don't think personally. There's always a discovery of understanding how to work with clients and understanding their situation, aligning their goals together if they're a couple. And what I found is generally people in households don't talk about this stuff, so it can be a little bit taboo, or they just haven't got time. They're busy and don't focus on it. And they when they break it down, they really do have some goals, but maybe just don't understand what the next step should be. So having a professional that does this day in, day out, has seen success from different clients, I think allows them to make decisions with confidence and then hopefully build a really trusting, meaningful relationship with that person. So it's a very personal experience talking about money. We all want more of it or need more of it. However, yeah, it's not always clear how to do that. So my experience has always been very customer focused and looking at the strategies that we can implement quickly to have good results and get people back on track if they're kind of flailing around a bit.
Makes a lot of sense, mate. And this is the reason why you're head of client engagement at Aureus, because this is your bread and butter. This is your area of expertise. So if we had to kind of drill down into client engagement from your perspective, Jim, what do you think the key is to a great client engagement when it comes to helping our clients build wealth?
Fundamentally, there needs to be a level of trust for people to open up and talk to you. And to try and establish that quickly, they need to see some vulnerability from you sometimes as well. So I've always believed that I'm a bit of an open book. And my philosophy was I'll tell you a bit about me. But let's see if we can open up this door. And I'm pretty good at that. I find that I can read people quite well. I have a high EQ, emotional intelligence, I think, and that's something that's allowed me to work with people. It doesn't work for everyone though, and that's probably one thing that I know, that people that have a higher IQ sometimes don't want to talk about that stuff, and it's not about feelings. It's so sometimes it can, that's where Chad probably comes in, and what we've found is understanding those different types of personalities really helps. Because yeah, you want to talk people's language, right? You don't want to be going down one path that seems right when the other person is, thinking something completely different.
Makes a lot of sense. So this is a great segue, Chad. You're head of strategy and investments at Aureus, and this is your bread and butter, what you live and breathe every day. So if you had to summarize what strategy and investments means in the context of working with our clients, how would you describe that?
Yeah, I think it really does depend on the resources that they've got at the time. So if you're looking at a client situation, you got to understand, okay, well, what can you actually do? Because that then dictates, the size of the investment, whether you go out buy a commercial property, whether you go do a development, whether you're buying your first home, whether you're getting a small parcel of shares, whether you're just investing into superannuation. So depending on a client's resources, and that will inevitably change because as we know within Australia, house prices go up. It allows a little bit more equity, and therefore you're able to borrow to invest, go to the bank and say, hey, look, I've got this security. So therefore, I want to go to look at my next investment adventure, right? So it really does depend on a client situation. And when I speak to clients, obviously everyone wants to go out and buy multiple properties and be retired straight away. The truth and the reality is, for most people, it is a bit of a slower journey. So we've got to accumulate. We've got to walk before we can run. And I think that when it comes to that investment strategy, the way that I think about it, again, is just really utilizing the resources that you've got. Because we've also got clients where they've looked at, wanting to borrow to invest into property, but their cash flow has been somewhat affected by what's going on with interest rates at the moment. So we can't go, oh yeah, let's go buy this property, when in actual fact you can't afford it. And that's just a simple reality. So it just really does depend at what stage of life you're at the resources that you've got, and therefore then we're able to look at, well, what's best going to swing the needle. Because from our perspective, it has to hit a couple of criteria, right? Like we got to think about capital growth, we got to think about income to some extent. Then we got to think about what structure to put it in, whether it's a self-managed super fund or a family trust, or if you put it in your personal name, do you put it in your partner's name because your partner's not earning the same level of income and therefore paying the same amount of tax? So all of it does combine, and it's not a one size fits all. It's not something that you can jump on Google and go, hey, cool, like, I want to start investing, or I want to start doing my preparing for my financial future. So it is one of those things that I think that when it comes to financial planning, it's really, really personal. And that's where, again, speaking to just elaborating what Jim has said, like when it comes to creating that investment strategy, sometimes people have different risk aversions where they feel more comfortable in a particular strategy versus, in other particular strategies. So yeah, it's all got to work together. So, and the only way that you do that is really starting to understand someone.
Yes. And look, this is where this all comes together beautifully, guys. And I think this is why we have the best value proposition in Australia, if not the world, around wealth. Because I've seen a lot of wealth businesses that have a high amount of technical nous and expertise. They've got great investment philosophies. They've got great strategies. There's lots of complexity, but they lack the client engagement piece. And as we know, like clients have a lot of anxiety around money as it is. If we can't engage them in that strategy, you can have the best strategy in the world, but if the client doesn't implement it, they're not going to get the goals. Vice versa, you can have the best engagement in the world, but you're lackluster on the strategy and the complexity, and therefore you are limiting the amount of results. And I think what brings this all together is the education. So in the business, I'm head of education, and I focus a lot on creating the framework. So we don't just do what we call a done for you with clients, where clients abdicate responsibility, but it's a done with you. And we actually take the clients on the journey and we educate them along the way so they can make better decisions. Because it's been my experience that unless clients can deeply understand what it is that we're doing and the reasons why, there's always going to be some resistance. And we're going to have to bring them along, in some cases, kicking and screaming. And my whole philosophy has been you can't want success more than your clients do. You have to both want it equally. And this is where we make money with clients and help them navigate uncertain times. So I'd love to hear from you, Jim. Like, what role do you think education plays in the advice process these days? How important is it?
Yeah, it depends on the client. I believe that people have a thirst for knowledge, the things that they are passionate about. So sometimes we will spend time on things that we really want to learn about, and we invest time into it, right? Some people don't want to learn about money. They just don't. I think they do in some regards, but to a point where they want to still hand it over. So I think that, but honestly, I mean, it's one of your something that you can't get away from. So I think you do need to have a little bit of knowledge, and you need to take some control, because even like you said, the best strategy in the world, if we don't implement it or we miss something, we're not going to get the outcomes. And I've seen this time and time again where, yeah, we've recommended strategies. People haven't taken the advice for various reasons. Looking back, they would have made a lot of money. And, sometimes you kind of like, you really just want to shake people because it's going to work, and you've got really confident idea of how things will play. Obviously, you don't know the future. But yeah, when you do see it and it does, when you kind of, you're sitting there watching people, it's difficult sometimes.
Yes. Yeah, it's very frustrating. Of course. Yeah, we've seen it. And it sucks, but at the end of the day, they've got to make the decision as well, right? How about from your perspective, Chad, what role do you think education plays in the advice process these days?
Well, I think it's massive. I think, look, you've got Google out there. You can research anything, and it comes up within less than a second, pages and pages and pages. And I think that Jim's exactly right. Like in the things that you're curious on, like I'm massively curious on mindset and human psychology and things like that. So therefore, I continue to learn about it because I know that it's going to help me with my own self development. So I'm massively curious on that. You know, um, educate me on how to brew beer. Probably not, probably not to the same extent. I'd rather go buy a beer and drink a beer rather than sit there and make it. So I think, yeah, you've definitely got to have a curiosity. But one of the key things that I've learned and what I've said to clients is, how do you actually fall in love with doing something that you hate? And like the funny thing is, you can change your mind on that. Like I do it all the time. And it could be like, how do I love, going to bed early? And you've got to tell yourself that, because quite often, like we can be so negatively drawn and not want to educate ourselves, sit there and say, you know what, I'm too tired or whatever it might be. And I don't want to do that. And it's quite easy to fall in that system and go, you know what, we've got Netflix, we've got Disney. It's not affecting our dopamine. Like we want that dopamine hit where it's like, oh, I want to go out to have dinner, or I want to drink a glass of wine or whatever. looking at your spreadsheet is not creating more dopamine. You're not getting excited. You can invest. You have to invest in yourself. And the key thing you got to learn is, like, you got to learn from people that have been doing it for 10 years. Like, if you're going to be doing it for an hour a week or an hour a month or an hour a year, you're nowhere near going to have the same level of education that someone that's doing it day in, day out, speaking to clients about it, speaking to other people about it, doing research on it, like, there's just no way. So I think that it's two pronged. Like, you've got to be curious. You got to ask the right questions. You got to keep asking questions and ask the right questions to the right person. And I think that, that's really key in the whole education piece, and just keep learning, be a professional student, really. No, don't ever be the master.
I tell you what's interesting, guys. We've spoken about this before. Like, I'm not motivated by money at all. And to be fair, I wasn't very excited about managing my own finances, even though it's what I did for a living. And it was only when I discovered that money was just really the means to an end for me of creating the lifestyle that I wanted and having the freedom and the choices, that I could actually create all of these systems that simplified the way that we manage our money, and spend as little time as necessary getting the outcomes that we truly want, so that we can focus all of that bandwidth on other things. And you're right, it's very much a mindset thing, because if you reinforce that belief that you're not a money person and it's too complicated and that you have to outsource it, then it confirms that bias, right? As opposed to saying, hey, I need to love this. No one's ever going to love my money as much as I do. I need to be curious, and I need to get some level of enjoyment knowing that money doesn't motivate me directly, but the outcomes money provides me motivates me. And it's a big reframe. And I think that's the kind of the themes that we share with our clients. And I think many of our clients align with that, which is really powerful. So, guys, we kind of serve four groups of clients, right? You guys had a very different client base to us before we merged. But the fundamental threads of how we serve those clients largely remains the same, but there are some nuances. So let's talk a little bit about that kind of pre-retiree and retiree space, because I feel that those particular clients have very particular needs. They also respond differently to market climate and market conditions. So starting with yourself, Jim, if you had to summarize the advice process and the advice philosophy for a pre-retiree or a retiree client, how would you summarize that, mate?
Yeah, I think there's a generation of people that are still very old school in the way that they like to do things. They like to shake hands. They like to look you in the eye. And these are things that have been, they've grown up with, right? And they're deeply rooted in people, and you can't force people to change. I think COVID pushed things along with technology. And a lot of our clients, maybe that weren't tech based, have now had to realize that it's inevitable. We're seeing it with the banking system. Banks are closing. People that, like, I worked in a bank for 7 years with Chad, and we're in branches and things. And you'd see people come in and they want to deposit money, and those branches are gone. They're predominantly, and those people are realizing now that they have to kind of move with the times. But ultimately, they want relationships. They want to trust people. They want to know that they're being looked after. There's a level of respect that's required. And I think that we would, when we look at a lot of retired clients, sometimes they probably look at us like we're the young kids on the block. Like, some of our clients are in their 80s, right? So they look at us. I look at Chad and his ripped jeans and give him a bit of a look up and down, like, who's this guy? But what we've found is it's what comes out of your mouth. And hey, tattoos, yeah, and that's it, right? But I think people, they base. Yeah, I know. They base a lot of their, people they look at people and they make judgments, but then once they get to know you and where we're coming from, we're able to break those barriers down regardless of age.
Makes a lot of sense. Cool. And from a strategic standpoint, Chad, when working with pre-retirees and retirees, what are the kind of the fundamentals that you look for when it comes to formulating a strategy for those kinds of clients?
Yeah, I think it comes down to behavioral finance. So The loss aversion, I think, is a massive one. We're seeing it now, right? So going through COVID, coming now from the Russian-Ukraine war, and what loss aversion is as we know, but people feel loss twice as much as what they feel a gain. And especially when it's kind of pre-programmed into us, to save for our retirement, save, 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 save. When people get to retirement, they have this feeling that they don't want to eat into their super, and if they're seeing the superannuation balance go down and they're taking money out of it, like it's that loss aversion, it's that extra sting. And so, look, from our perspective, like one of my key focuses has always been I want to try and create the best portfolio that money can buy. When it comes to superannuation or pensions and things like that. And the whole reason for that is I'm the one that's in the know. Like it's like when you go see your mechanic. Like I don't know. Like my old boy was a mechanic. Like I know how to check the dipstick for oil. I know how to check the radiator for water. I know how to change a tire. I know how to turn the ignition on. That's basically it. So, when you go to see a mechanic, you want them to turn around and go, hey, look, you can use this aftermarket part, or you need to use this genuine part, or, the fan belt's going to go, at this particular point, or, the wheel bearings. You want someone that goes, cool, I know what you should do, and these are the products that we recommend. That's how I take it. That's how I value it. I'm in
Yes.
the industry. I'm trying to look around, and like we're not always going to get it right, right? Like we're not always going to get it right at all. Like it's just we're dealing with other investment managers where we're reviewing them. Sometimes they work better in different markets than in other markets. But I guess like the key thing is, I want to try and look at in terms of strategy, like again, how do we help the client? So coming back to the whole loss aversion, even if their portfolio goes down a little bit more in this particular market, but it makes more in other markets, like overall, I want to make sure that I'm doing the right thing by them so that they can feel like, okay, cool, well, this guy's got my best interest at heart. He's checking
Yes.
everything. And, over the long term, we should be doing better because we've got that guidance, we've got that education.
Makes sense. And look, here's where the education comes in, guys. Like I have worked with a lot of retirees over the years, and the thing we've got to realize is that retirees, because they've made their money and they basically need to preserve capital because that's what they're going to rely on in order to live their best life for the remainder of their days, they can have a lot of anxiety around basically protecting those resources. And really, there's two currencies that they want. They want peace of mind and they want certainty. And there's nobody in this world, even though I might look like a wizard, that can forecast accurately into the future, right? And this really comes down to helping educate these clients so they don't make knee-jerk and emotional decisions that are detrimental to their future wealth. And this is where we start talking about things like the bucket strategy, right? This is about understanding we've got the appropriate resources in order to protect against some of the unforeseen circumstances that will inevitably occur. We know that markets on average have one negative year out of every 4 years. But if there's one negative year out of every 4 years, it means there's 3 positive years. So all we need to do is to develop the money muscle memory and the perseverance and conviction to stick to the strategy throughout those turbulent times so we get out the other side. And this is the unfortunate thing that I started my career in the GFC, and it was like an indoctrination by fire, right? And I saw people who were trying to resource guard and had sold down all of their assets into cash and crystallized 40% losses in their portfolios. And they'd never recovered. Whereas those who were able to stick the course, who could stomach the fall and could wait to get through the other side, and sure, there were some tough times I needed to navigate, they've actually been able to far outperform and have been able to get that peace of mind and certainty. But that come down to the education. And I think that's really important, particularly with that market. Would you guys agree?
Yeah, I just want to share two things. So one thing is, and I've got some pretty good charts on this, is timing the market. So there's some research using the Australian share market. So when people watch the news and they talk about the ASX, so it's the ASX. If you were to stay invested with the ASX, I think it was, I can't remember whether it was over 10 or 20 years, and I think it was 10 years, sorry. And if you had invested over the past 10 years, I think the return was around about 7% per year, right? So everyone always likes to think about property doubling in value. Well, if you actually break that down, that's 7% per year. So the share market was doing, let's say, on average, 7% per year. Now, the funny thing is, when people try and time markets, if you miss the best 30 days in that whole entire period, guess what your return is? Negative 2% for the whole entire period.
Yeah, wow, that's a massive difference.
Yeah.
Wow.
So that's one thing. And then the other thing was exactly to your point. I've looked at when at the pinnacle or the trough of GFC, if you had invested for 1 year in cash and then invested in I think it was the ASX as well for the next, until I think it was 2021, the difference was about a 30% loss. So investing 100,000, it got up to like, let's call it 300,000 or 300 and something thousand. The difference was $100,000 or roughly around about a 30% loss if you kept your money in cash and basically running for the hills. Now, just when we think about when we're investing in shares, the whole principle behind it is we're business owners, right? Like if someone wants to invest into our company and buy shares in our company, it's our job to try and create more money. That's what shares are. And I think that sometimes there's that disconnect when people are thinking about shares. They're like, oh, shares can go up and down. Yeah, they can. But the key fundamental thing is it's everyone in that company is trying to make more money for that company. If they make more money, share price does well. And I think that's something that people kind of sometimes forget. They're just like, oh, it's shares. Well, no, there's actually a company behind it. But there are just a couple of things
Makes
I want
sense.
to share when it comes to
Great
timing
example.
markets.
I love it. Jim, your comments, mate.
Yeah, the GFC I think was tough. I think people have short-term memories as well of what these things are like, and generally I think we definitely want to try and avoid that feeling of pain. But like when we were going through it, we did have a bunch of clients that sold out, and you're right, they never recovered their money. And following tough times, there's generally good times, and that's what we've seen historically. And so I suppose we're in a really good position to educate clients about that. And I think that that's really our purpose, is to make sure that people don't go and make silly decisions, because it's hard to recover. I think that's something else to think about, is sometimes if you never go back and invest again, you've lost forever. And so my philosophy is always to keep investing, try and find the right investments that suit your risk profile or tolerance, and make the decisions up front. Stick to the strategy, look into the goals that are important to you, and make sure you stay focused on what's important.
You nailed it, mate. I think if you're really nervous and your sleep at night factor is being impacted by your investing, no matter your age or life stage, it's an educational problem. And we know that the more educated you are and the more knowledge you have around investing and wealth, the more peace of mind you have to be able to stick to the plan over the long term. So I think that's important. Now let's make a segue, guys. Our next biggest client subset are wealth accumulators that are business owners. So I think this is swinging the needle to the complete opposite side. So guys, starting with you, Jim, if you had to describe what it's like providing advice and engaging with business owners as clients when it comes to wealth, how would you describe that?
Business owners are fundamentally a lot busier. They take a lot more risk in their business. Sometimes they can need to be a little bit more conservative with their money, because they do need to have extra resources available if things go wrong. So cash flow becomes a huge component for any business owner. They call it the lifeblood, really, of the business. So I think where we've been able to really support business owners is having a philosophy around that, to create the war chest, to create the ability to pay themselves more, to get away from working themselves to the bone with no reward. And I mean, that's how we met, right? we met you guys, and your philosophy around this was exactly what we were thinking. So as a business owner myself, you put in the time and the effort, and you want to be rewarded for it. And I think that a lot of the time we lose focus of that because we sometimes have self-limiting beliefs and what's potentially possible. And again, we can get in our own way. So I think that having someone to actually educate you and coach you through making some really pivotal decisions in your business is almost more important. So taking that next step, is where I think we can really help clients.
Beautiful. Great segue, Chad. As being head of strategy and investments, business owners are impatient by definition, typically, and they have huge amounts of complexity in comparison to, say, a normal PAYG or a retiree. So when it comes to formulating a holistic strategy for a business owner who wants to create wealth, what are the nuances to that process that maybe people overlook or misunderstand?
I think when thinking about a business owner, I think they're probably just in a different category, and the main reason is probably resources, right? So when you're a business owner, generally speaking, you've got probably more quote unquote disposable cash through the business, sometimes more than, say, for instance, POYG. Now, that can highlight a couple of things. Now, that can look at you can invest then, therefore, into like commercial property, especially if you are paying rent on a commercial property. So you can invest into a commercial property instead of you as a business owner paying rent to a landlord. Then you're just paying it to either a family trust or your self-managed super fund. So you can add different strategies than, say, for instance, PAYG, because PAYG, your commercial property, you're not paying for that. So you don't have to think about that. You can still set up a self-managed super fund. You can still buy a residential property, but it's just a little bit different. The strategy and the value and the net wealth growth is going to be superior simply because instead of you paying 50, 60, 70, $100,000 to a landlord, you're paying that to yourself. So the strategies that are involved with business owners, like to what Jim's saying, is a little bit different, utilizing different resources like trust structures and setting up bucket companies and things like that. And ultimately what that does is it just creates different paths of wealth. So when we're looking at predominantly PAYG, you can invest into the normal, what we call asset classes, which are, your shares, your property. You can look at fixed interest and bonds, your cash, private equity, things like that. But again, when it comes to when it comes to small to medium businesses, they can look at the commercial property aspect as well, and utilizing family trust, which a family trust you can't utilize with PAYG. And again, then you can start splitting incomes and things like that, which, if you're a business owner, and your accountant's not doing that, probably ask them why.
Yeah, this happens all the time, right? And look, I love working with business owners because there's just so much value that we can add. And it's an area, obviously, I'm very passionate about because that's why I started in this industry, providing advice and educating people around money. But I think the big issue here, that what we battle against, is that because business owners are impatient and they have this immediate gratification of making decisions and getting immediate results in their business, they see wealth as being super boring and like a long-term later thing. And it's about finding that balance, because their business can be the best wealth vehicle that they can ever have, but most business owners end up kind of squandering the resources that they create in their business because they don't have the appropriate wealth structures in place. And the whole methodology here is maximize profit, maximize business value, systematically turn that business profit into personal wealth, so we can create financial freedom faster. And there's a lot of sophistication and complexity that goes into that. But I think we do it the best in the industry, if I have to kind of blow our own trumpet, because we're really the only ones that are specializing in this space. And our client results speak for themselves. So let's just do a quick touch on kind of the other two segments of clients that we work with. So there are kind of time poor executives and those who are in kind of a high flying corporate career. And then there are also those people who are just getting started, who typically are like referrals from our existing clients. Maybe they want to help their kids get started and get a foot on the property ladder, whether it be that they're trying to prepare their kids for generational wealth. So when we talk about kind of like the general employee market, and let's kind of just categorize both of those people in the same conversation. Jim, when it comes to getting started on your wealth journey as an employee, what are the key things to consider from an engagement standpoint working with a financial advisor?
Yeah, again, the fundamentals are very similar. We want to understand and align goals for people, focusing on what to do next. What we generally have found is people do what they're comfortable with. So they look back at what their parents did, and they'll generally adopt a very similar strategy to what they were doing. So buy property. We all know that that's the first thing that you do when you get married, you have kids, you buy a house, you pay that mortgage back. And I think that when we find a lot of people, they come to us, they usually have started to do that. But is that going to get them to the actual, retirement goal or cash flow goal and all these things that they really need longer term? Probably not. So what we've found is by reverse engineering the numbers for what they need for retirement, what they need for passive income, we quickly find that what we're doing is probably not enough and we need to start exploring other strategies. What we've found is working with an advisor, you're far more likely to achieve those goals because we're just focusing on it. So it's accountability and focus around why you'd want to do it and why you should continue focusing on it in the future.
It makes so much sense. Like, this is the most fun part of this exercise. Like, I've worked with some of our sophisticated clients' kids, for example, who just got started. And they've approached the process pretty blasé, and we've gone through the road mapping and the forecasting. And we've been able to show them, like, there's hundreds of thousands of dollars in many cases of opportunities that they haven't tapped into, even with modest incomes. And it just positions like the investment that they pay to us, which is pretty substantial, right? We're not cheap. However, the amount of value that we're able to bring to the table through just making some tactical and strategic shifts in that approach, in that roadmap, can be worth like multi six figures, in some cases 7 figures or more in added value if they just elevate that roadmap, and they wouldn't have known otherwise. So that gets me super excited. And I know this gets you excited as well, Chad. So the question for you, mate, from a strategic standpoint, I think many people believe that in order to see a financial advisor or a wealth coach, you need to be wealthy already to get most value from it. Is that true from a strategic standpoint, mate?
No, not at all. I mean, like I caught up with some clients the other day, and like, yeah, the household income is pretty significant, but I mean, they still have the normal issues that everyone does, right? In terms of cash flow, in terms of spending too much, in terms of not really understanding where they're spending their money on. Um, and a couple of key things that I was able to add value straight away is just by looking at their mortgage, right? So looking at their mortgage wasn't necessarily the interest rate. Yeah, I'm not a mortgage broker, so we refer that onto a mortgage broker and try and reduce the interest rate. But it was just about how much, if they just paid an extra $500 per month, onto the mortgage, where would that lead? And I know that $500 to some people might be a lot. I mean, you think about it, $125 a week, 25 bucks a day. Is there $25 a day that you can move into your mortgage? And the difference was hundreds of thousands of dollars in terms of interest paid over a 30-year period, because every time it's like compounding interest, but in reverse. Like with compounding interest, you put your money in, you invest it, you get the interest, and then the next time you get the interest on top of the interest. Well, the bank's doing the exact same thing, but in reverse. So each time that you're not paying down that additional interest, it's just extending the life and increasing the interest. So just something simple like that was able to save hundreds of thousands of dollars. So I think that there was another thing that we had contemplated. They're currently renting at the moment, and they've got an investment property. Actually, they were kind of considering selling the investment property and then going out and purchasing their own home. Now, in this particular market, we looked at what the interest rate was going to be. We looked at the repayments, what that was going to be. Now, they wanted to buy, a fairly nice house, and it was going to cost them millions of dollars. Now, the repayments on that in this environment was going to be something ridiculous, like $13,000 a month or $15,000 a month, versus where they're renting at the moment for 4.5. And like I said to them, are you going to come up with an extra $10,000 a month when basically you're spending, your expenses? And the simple reality is, people get used to a certain lifestyle. So again, that's immaterial of, whether you're, in the top echelon in terms of income or, just starting out. People still need to try and understand numbers. And that's
Yes.
not everyone's field. And it's trying to understand the numbers and trying to understand tax. It's trying to understand a mortgage. It's trying to understand all these things that there's no school for it. And so we just happen to be interested and curious in this industry. So therefore we learn and then we teach. And I think that's the key fundamental difference, irrespective if it's, PAYG or not.
I agree. And look, I think this comes back to this principle, this behavioral finance principle of mental accounting, right? And this, most people, when they look at making these decisions, they do the numbers in their head. They've got this kind of this subjective view of what they think, which is kind of confirmed by what we call confirmation bias, that they lean into what they already believe, right? And as part of being an advisor and a wealth coach, our job is as much to help our clients make the right decisions as it is to talk them off the cliff of making wrong decisions. And it's particularly early in your wealth accumulation journey, avoiding making wrong decisions can save you not only the tens of thousands, if not hundreds of thousands of dollars, but it's also the opportunity cost of that compounding effect of not having diverting from the course and then having to make your way back on track. And this is why when clients work with us, yes, it is typically the most significant investment that they ever make in themselves. But because we can quantify the results of their certain decisions in the various pathways, that the return on investment is exponential. And it's not just investment returns. There are so many facets to how we manufacture value for our clients. And when we can show clients that value, it's an absolute no-brainer. So that's what gets me super excited. Awesome, guys. I think this gives people a really good idea of kind of how we do things. Because look, there is a lot of ambiguity, right? And I think a lot of people ask this question of what exactly do you guys do? So I think we've done well to share some insights around what that looks like. So let's have a little bit of a change of tact here, guys. My view is that we're long overdue for a substantial market correction, right? Like we haven't seen substantial market correction since the GFC, which is coming on 15 years now. And I think people, as you said, Jim, have short memory spans. They've forgotten the GFC. Even many of our clients weren't actively investing in the GFC. And there are some warning signs for things to come. So, Jim, from your perspective, mate, what's your view on financial markets in 2023?
I think there is some. It's obviously been a tough year, a couple of years, and I think we talk about these once in a lifetime events which have happened, they just keep happening. So I think that from my perspective, I'm quite optimistic, and that's probably one thing for me. And I know that doesn't always sit well with people. However, I believe in resilience in markets, in companies, in the economy. And even though things can get bad, I never believe in the doom and gloom that subscribes to people getting out of markets. I think things can artificially be created. So I think that some of the time when we watch the news, people get fear, and that can perpetuate, the actual situation. Personally, my money's always going to be invested. If anything, I'm looking for more opportunities in these times. And most of our clients, I'd say, bar one or two, generally understand that long-term investing works, and they've been doing it. Like some of our clients in their 80s have been doing it their whole life. And they've never, and they know that this is going to happen again, and they've been through it before. So I think if you're new to investing, you're not quite sure, I would say get advice and set your strategy up. Make sure it suits you.
Makes a lot of sense. Awesome, mate. And Chad, how about you? What's your view on 2023 and the markets?
Do you have half an hour? No, kidding. Look, I think from my perspective, look, I kind of changed my tune recently. So I thought that property prices will come off quite significantly because I read a few articles where the CBA, Westpac, ANZ, a lot of these big lenders, they had all their fixed home loans that were rolling off. Add on to that, we speak to clients on a daily basis. There's a number of clients that are like, hey, my mortgage has now gone up pretty significantly. And I'm not talking $100, I'm talking thousands upon thousands of dollars. And so my perspective was there was potentially at the back end of this year when a lot of fixed interest rates were going to roll off. They call it, it's been termed the mortgage cliff, but that was going to roll off towards the back end of this year, people that had been fixed from COVID. And I thought that there was potentially, mum and dad, they might have a house, they may not have a house, they got an investment property. Okay, well, we got to rein in the belt. We got to potentially sell that property. If a multitude of people do that, then you are going to increase the supply. If people can't go and get the lending, or the lending is only, 800,000 when previously they could get 1.2 or 1.5 million dollars, there's this bit of a disconnect, right? Like if there's too much supply and people can't go out and there's not the demand, then prices will come off. That's what I thought. Now, something that has recently changed my perspective on that is net migration. So the amount of people that have actually come into Australia, and I live in Sydney, and the amount of people that when you go look at rental properties, there's 20, 30, 40 people that are looking for rental properties, and the rental market has jumped up by 20, 25, 30%. So that then, if you're a homeowner or an investment property owner, and you previously saw your mortgage shot up and you're like, hey, my rent's still there. Well, if your rent is now starting to increase and you can kind of manage that, I don't think there is going to be as a significant drop off as what I thought probably, 3 months ago.
Yeah.
Just simply, I don't think the government had planned this, because I don't think the government's smart enough. But I think that just out of that net migration coming through, I think it won't be as tough, and I think that people will still rein in the belts. They'll stop spending as much. Inflation will come down. Interest rates will, slowly start to peter off, and then I just don't think it's going to be maybe as significant as a drop as before.
Yeah.
But yeah, that's my 20 cents.
I think those are really good insights. My philosophy on this from an educational standpoint, and what I'm focusing on with our clients around educating them to prepare for this, is all about the principle of understanding what you cannot control and focusing on what you can. And what we can't control is what the markets do at a macro level. And like you hit the nail on the head, Chad, like vacancy rates in Sydney at the moment are 1.3%. Back in the day, we used to say a balanced market was a 3% vacancy rate. So it is basically less than 50% of what a balanced market should be. We've got some areas that have like a 0.5% vacancy rate. So if we understand the fundamentals, then we can better choose the quality of the assets that we are acquiring. Next, we're talking about equity markets. If we focus on buying companies based on their true fundamentals, do they have strong profitability? Have they got economic moats? Have they got strong balance sheets? Have they got good liquidity? Do we understand those fundamentals? Sure, people's perception and the fear in the market can impact what happens to the share price, but if the business is fundamentally strong, then it's likely to stand the test of time. And then when we talk about small business as a business owner, the same principles apply. How do you build an economic moat? How do you make sure that you've got a business that can produce consistent cash flows through different market conditions? How do you ensure that you protect your profitability and you build your war chest, and that you can maintain liquidity through tough times? And these are the things that you can control. And what this comes down to, you spoke about this before, Chad, is this loss aversion bias, where people feel the emotion of loss twice as significantly as the emotion of a gain. Well, how do we combat that? You need to put twice as much effort into your future planning and the reasons why your future goals are important to you than you do about resource guarding. Because intrinsically wired, you're going to try and maintain the resources that you have, unless you're really sold into why you're working so hard and why you're enduring the volatility in the first place. So way I see it is that the only way to stick the course is to make sure that you truly understand that strategy. You understand the game plan and how you're supposed to respond, and that you are building what I call that money muscle memory, so you don't do erratic things, because the erratic decisions is what costs you the most money. Would you guys agree?
Yeah, I would.
Definitely. I think again, it's easy, and it's pretty easy for people to fall into status quo bias as well. Like where they're just worried about maintaining the status quo and not stepping out. Jim and I, we did a questionnaire for clients that were coming on board, and we found that those clients took 3 to 5 years about thinking about financial advice before actually taking the step. So which is really interesting, right? Like our own human psychology and behaviors are, we want to maintain what we're doing right now, because there is the potential that if we make that decision, it could be a wrong decision. And I think that that's something that everyone suffers from, right? But the more knowledge you have, the more strategies you can think about worst case scenario and the shit hitting the fan, the better that you're going to be prepared. So if you can go, all right, cool, this isn't that much of a bad scenario because I've got more money in my bank account, or I've got an offset account, or, we're managing our finances pretty well. Like if you're able to think about all the strategies around, and again, this is what Jim was talking about before, different personality types. So those detail orientated people, if you can do that, or the fear driven people, if you can do that, then it helps you make those decisions. So you're exactly right, just by trying to look at different scenarios and strategies and, staying the due course and continually reviewing them.
Makes a lot of sense, guys. So there's a bit of an elephant in the room that we need to talk about, because over the last week or so, there's been some significant events, and many people are talking about these events potentially being the catalyst for the next GFC. And this is these US bank collapses. We've seen Silicon Valley Bank collapse. I think they were the 18th biggest bank in the US, and now the second biggest banking collapse in US history. And we've also seen another New York bank collapse, for very similar reasons of this thing that they're calling the bank run. Jimbo, do you want to give us a little bit of insight of what's happened, mate, and what this kind of means for investors?
Yeah, look, I was having a bit of a listen about long duration bonds and how that was part of this. So they'd have to sell off at a loss effectively when they were investing, when people wanted their deposits back. They tried to do a capital raising for a couple of $1 billion, and they spooked the market, and people wanted to pull their money out. And I think that's I remember during the GFC when we had a cash guarantee of $250,000, right? I think it was per bank, because people were worried, right? Like if you think about when you put money in a bank, you fundamentally think that it's safe, right? I think that that's one place that we're taught that money should be safe. So the fact that people are losing money investing in banks is a concern. And I'm sure that people would be worried about that because, they would be thinking, is my money safe at the bank? I think that Australia fundamentally has a lot of very big differences in the banking system. And we found that out during the original global financial crisis as well. So we have better policy that protects consumers. There's a level of protection that I think just works better in Australia. So I'm not significantly worried for our banking system, but it'll be interesting to see what the fallout of this is.
Yeah, it's interesting, mate. I think you're exactly right. I think we're very fortunate here in Australia. I personally believe that the Australian market will navigate itself past a recession similar to like the GFC, where a lot of the world was impacted. Australia escaped relatively unscathed. I think we're relatively conservative as a population. Our big banks are quite conservative in nature. The policies that were recommended, called the Basel provisions off the back of the GFC, that were implemented to stop collapses like the Lehman Brothers ever happening again, Australia fully implemented all of those provisions that were recommended. So they are great fiduciaries, and I believe that they make sound risk management decisions. Does it mean that we're immune? No, that you never are, but it does give you peace of mind. So, Chad, from your perspective, what changes from an investment philosophy when these kind of systemic issues present themselves in the short term, and what impact does that have on client portfolios?
Yeah, look, there's always going to be an impact, right? Like with significant news, there's always going to be an impact for clients because, again, fear comes into it, right? So I think what you were saying before around our banking system's different in, I suppose, a multitude of different ways. Some of those banks were actually private equity banks, so they raised a lot of capital. And you're talking about like some of these companies that you're investing in, your Uber, your Netflix, Tesla, they're not actually making money. They're not actually, actually getting ahead. It's all on the premise that at some point they're going to make this profit. So, these companies are valued at, sometimes 50 or 100 times what their net profit actually is. And it's ridiculous. And that's Silicon Valley, right? Like everyone's anticipating that these things are going to be, bigger than Ben-Hur. And I think that's going to shift. So that's going to shift in valuations and how these companies are going to be valued because, no more are they going to go, oh, okay, well, we're just going to believe in what you're going to say. And, we're going to invest, you're talking huge amounts of money, like Mark Cuban investing huge amounts of money in whatever company, just on the premise that it could take off because there's 330 million people that they can sell to in the US.
Yes.
Australia's not like that. So a bit of a different market. And I guess the other thing when we think about our banking system is we've got recourse loans. They have non-recourse loans where in the GFC, what had happened is, okay, cool. I can't pay back this debt on my house. I hand back the keys. Yeah, there's a loss on that property. I go buy next door. There's no recourse. And so, again, we're probably structured in a little bit different ways than what the US is. It's still going to have a flow-on effect, though. It's still some of those companies were invested in some of the companies that, our investment portfolios are invested into. But I think that the key difference there is some of those smaller companies, we weren't investing in them. So, but it still does have a flow-on effect to, market sentiment.
Makes sense.
One other thing I will make mention on is that if you look at the ASX, so the Australian share market versus the US share market over the past, call it 6 months, it's actually fared better because interest rates have been going up in the US because of inflation, and it hasn't been curbing or slowing down inflation because everyone's on a fixed home loan, whereas here we're on variable. So because we're on variable, we feel the interest rates more. And as a direct result, we're probably going to have a bit better of a landing when it comes to inflation. So a couple of those factors all thrown into the mix, plus as well what you're talking about, that capital that the banks need. I think we're just a little bit different to the US.
Makes a lot of sense. And look, I think this is the difference between speculation and strategy. We focus on strategy with our clients. We focus on the long term. And sure, we need to navigate the uncertainties and the volatility of particularly black swan events in the short term. But we don't do so in a knee-jerk and emotional way. It's all methodical and it's outcome oriented. And I think this is what clients need in this market. So, guys, it's been a phenomenal chat today. Hopefully, we've given some insights to everyone who's been listening and watching. So anyone who's watched this and listened, if you're interested in getting some advice, interested in getting some wealth coaching to be able to help you, maximize your plan, create more cash, allocate it to the market, particularly in turbulent times, or manage what you've got, feel free to reach out to us. Make sure you complete our 40-point wealth performance scorecard. Link is in the show notes. It'll help you work out what you need to focus on in this market. And if we can help in any way, feel free to reach out. The guys will be more than happy to support. Jim, Chad, appreciate you making the time and look forward to catching up again soon.